Do you need to report your Dominican Republic bank account in the United States? Maybe. If we haven't met before, my name is Javier Diaz, and I'm a certified financial planner professional. And I specialize in working with U.S. persons who live full-time or part-time or invest in the Dominican Republic. Now, you might be thinking, well, my bank account in DR, the U.S. doesn't know about that. I don't need to report anything. Not so fast. If you recall, when you opened that bank account, what was one of the things that they asked you for? Your U.S. passport. Even if you have one of these, if they have any inclination that you are a U.S. person, they still ask you for your U.S. passport and your social security number. Why? Because they're required to under FATCA, which is the Financial Accounts Tax Compliance Act, which is a law in the United States that requires U.S. financial institutions, okay, in order for them to transact with foreign financial institutions, those financial institutions need to comply with that reporting requirement. They need to report all U.S. persons who bank with those foreign institutions, okay, or at least keep track of them. Now, with your Dominican Republic bank account, you may be required to fill out what's called a report of foreign bank and financial accounts, commonly referred to as an FBAR. Now, who must fill out an FBAR? Well, a U.S. person with financial accounts located outside of the United States whose maximum aggregate balances exceed $10,000 at any one moment throughout the calendar year. Let's break that down a little bit. So, U.S. person, what does that mean? Who is a U.S. person? Well, a U.S. person is a U.S. citizen, a resident, or an entity created, organized, or formed in the United States, including but not limited to a corporation, a partnership, a trust, or an LLC. All right, those are all U.S. persons. Now, the $10,000 threshold, how does that work? Well, you take all of your accounts, you see if on any one day throughout the calendar year, those balances went over $10,000. So let's say in account A, you have $9,000. In account B, you have $3,000. You might say, I'm good. None of those accounts are over $10,000. It's in aggregate. So you take $9,000 plus $3,000, it's $12,000. You've clearly gone over the $10,000 threshold. So you are at that point required to fill out an FBAR. Now you have to keep track of the maximum balances in all of your foreign accounts, okay? So not only on the day that the aggregate amount, let's say on April 1st, when you had $9,000 in one account, $3,000 in the other account, $12,000 on that day, that triggers your requirement. But let's say account B that had the $3,000 in June had a maximum balance of $5,000. So when you list those accounts on your FBAR, you'll list the $9,000 if that account never went over that, and in account B, you'll list $5,000 as its maximum balance. Now, when listing your maximum balances on your FBAR, if your accounts are in pesos, you have to convert them to dollars. Now, you don't use the conversion rate or the exchange rate of the day that it went over the $10,000 or when the maximum balance occurred. You have to use the spot rate provided by the U.S. Treasury Financial Management Service as of December 31st of that calendar year. So if you're filling out for 2025, okay, you have to go back to December 31st, 2025, see what the rate was, and use that as the conversion rate to fill out your FBAR. Now, financial interest, okay, what does that mean? So, if you have financial interest in or signature or other authority over those foreign accounts, you have to include all of those accounts in your in your aggregate account to see if you've gone over the threshold, or for the reporting purposes. So if the account is in your name, clearly it's your financial interest and your signature authority, so clearly that counts. But what else? Well, let's say you had someone else. You just begun your journey to DR, so you had someone else, a relative, a girlfriend, whomever, open an account in their name, and they deposited your money to get yourself going with purchases or whatnot. Well, it's your financial interest. That account counts as well. You have to take that into account as well. Now, let's also say an account in your name, but let's say Abuelita finally sold that land that she's been holding on for the longest. You open up a bank account for her in your name. It's her money, but it's in your name. You clearly have signature authority. Well, that account has to be counted as well. Also, let's say you have poder, or power of attorney, over someone else's account. Again, a family, your mother, whomever, you have power of attorney over their account. That account must be counted for as well. Let's also say you have an SRL or any other entity in the DR that has its own bank account. If that bank account goes over $10,000 in aggregate, because since if you are more than 50% shareholder in that SRL, then that one has to be counted along with your personal accounts. And if you are again triggering over the threshold, then that account has to be reported as well. Now, I did mention that U.S. persons are also U.S. entities like LLCs. So let's say you have an LLC in the U.S. that owns your DR SRL. Well, if the SRL's account goes over $10,000, then your LLC has to file an FBAR as well. And the LLC, if you are more than 50% owner of that LLC, well, now that triggers you to fill out an FBAR as well. So you have to fill out 2 FBARs, one for your LLC and one for yourself. Now, you might be thinking, well, I don't ever go over $10,000, I'm good. Ojo with that, okay? Keep an eye out. Many of you have made purchases. A car, furniture, made a down payment on some property, or made payments on your property. You transferred over $10,000, $15,000, $20,000, $25,000 to your DR bank account. As soon as it cleared the transfer, you withdrew the money and made your purchase. Even if the money doesn't spend 24 hours in the account, as soon as it hits your DR account, that account exceeds the threshold. That one moment throughout the calendar year, it triggers the requirement for you to fill out an FBAR. So be careful with that. I know many of you are going to get caught on that net, so you would want to fill out your FBAR there as well. Another thing to keep in mind, if you have an account in DR, you also have an account in Colombia or in Brazil, wherever it might be. If either just your DR accounts or your DR accounts plus those accounts triggers an FBAR filing, all of those accounts have to be included. Also keep in mind that even if an account has a 0 balance, if the account is open, then it has to be listed on your FBAR as well. Now, an FBAR is an individual requirement to fill out. So you might think, well, if I'm married, do both of us need to fill out an FBAR? Maybe. So it depends. So if all of your accounts are jointly held, okay, and let's say your spouse doesn't have any separate accounts, but only has the joint foreign accounts with you, and you guys have to fill out an FBAR, well, at that point, you can file one FBAR for both of you. Now, both of you have to fill out Form 114A, which authorizes another person to fill out an FBAR on your behalf. But again, at that point, you can fill out one FBAR. Now, let's say you and your spouse have joint accounts, but you have an account over here and she has an individual account over there as well. If either between the joint accounts and her separate individual account, either just the joint ones by themselves or her separate account in addition to her separate account triggers an FBAR filing, then at that point you have to fill out two FBARs, one for yourself and one for her. Now, when are FBARs due? FBARs are due on April 15th. What else is due on April 15th? Well, your U.S. individual tax return, that is. Now, do you submit FBAR with your taxes? No, you don't. So that can be a little bit confusing. So your FBAR is submitted only through e-filing through FinCEN. Okay, again, that's the Financial Crimes Enforcement Network, which is a part of the U.S. Treasury. Okay, through their BSA e-filing system, you'll be able to submit your FBAR. Now, we're only a few weeks away from that deadline, so you want to make sure you get your FBAR in, as the fines and penalties can be hefty, anywhere from $10,000 to hundreds of thousands of dollars, and or prison time. And it all depends on whether it's willfully or non-willfully that you miss your FBAR or make false representations on your FBAR. Now you might think, well, what if I miss the deadline? I'm screwed. Well, you get an automatic extension to October 15th. So if you can't make it by April 15th, no worries. Just make sure you get it done by October 15th so that you can stay in compliance. And if you enjoyed this information, please consider subscribing to my channel, giving this video a like, and turning on notifications so that you don't miss more videos like this. Because you want to be thriving in DR, not just surviving. Till the next one, take care.